we'll probably just do, sort of like, what were we saying, like a webinar type thing? Yeah. So I think when we get back in the studio, we'll record it and then send it out. Just because we are making this available, like I'm being streamed, on YouTube Live right now. But just so that it's a lot more clear, audio and everything, we'll go ahead and send it out to everybody that wasn't able to attend, because we had actually over 200 registrants. There was supposed to be over 100 here today. So yeah, that's why we were a little bit surprised. But we were told yesterday, because of the situation, that yeah.
So feel free to grab seconds. Or
thirds and fourths. Definitely feel free to just take like 5 plates home. So of you four, I guess, which are new or which were here last time at the first conference in August of 2018? Okay. No? New. Okay. All right. So something I realized last time is I got here and I just assumed that everybody knew my background and who I was. And then I realized a lot of people were just like, who is this guy? What is this firm? What's going on? They're just completely in the dark. So I thought it best if I just give you kind of a brief history of how this came to light, who I am, what our firm does, and all of that. So just to recap, for those of you that are new, this started in 2016. There was a JDFPG contractor by the name of Scott Meredith, and he's allowed us to use his name. He was unhappy with the tax situation, and he started researching online to find a firm that specializes in international tax matters, in particular a firm that specializes in private individual tax matters. And as he researched, he learned a lot about our firm, Castro & Company, and its founder, me, John Anthony Castro. So just as a little bit of background, I'm a graduate of Georgetown University Law Center in Washington, D.C., and I earned my Master of Laws in Taxation with certification in international tax. I also earned my Doctor of Jurisprudence from UNM School of Law, and I'm also an OPM Fellow at Harvard Business School. So suffice it to say, very well credentialed. I also have 2 published books, International Taxation in Plain English and International Estate Planning in Plain English, the former of which is actually used as a textbook at the University of Maryland's R.H. Smith School of Business. So on top of that, I have over 50 published legal research articles, and I've been covered in newspapers and magazines in both the United States and Australia, including the Sydney Morning Herald. So on top of being credentialed, also very well known in the industry, and viewed as kind of a leading authoritative figure in the world of international tax. So when Scott Meredith saw all of this, he felt, okay, I think I've definitely found the right firm. It looks like they're exactly what we need. And not only that, but our firm only specializes primarily, like 95% of our work is private individuals. There is a lot more money in corporate work, but I actually enjoy personal interactions with people. So, and also there's just a huge vacuum. Nobody services private individuals anymore. And they just view it as, for some reason, they view it as not profitable, but I think it's because they're still thinking about the antiquated hourly billing structure. We have a different type of billing structure. So he contacted us, we spoke, and we agreed to look into the issue. So the first thing that any firm does when we get sort of any inquiry online is if we think that it merits our attention, then we assign it for legal research. So we look to see, is this an issue? And is there anything that we can do in this type of a situation? And from a, strictly from a business standpoint, because we're a company, we have to generate revenue, we have to see whether or not that this is an issue that we can actually resolve. If it's not, so any type of law firm deals with this. So when somebody comes through the door, let's say if you're a personal injury attorney, you have to assess the situation. Like, was it really the company's fault that you got injured, or was it your own fault? And because if not, you're going to spend all that time and resources in dealing with the case and not get anything out of it if you don't actually solve anything. So the first thing we did was we researched the issue. And so I'll give you a little bit of background on that. That way you understand exactly where this issue came from and where it's headed. So first, there's the 1966 Defense Agreement, which, by the way, it's not a treaty. It's under US law because it was neither signed by the President of the United States nor ratified by the US Senate. The Defense Agreement creating JDFPG was signed before income tax treaties became the norm. And under international law, generally wages are sourced and taxed in the geographic area of physical performance. So that means that if you moved to Australia to accept a job offer, whether that be with a private company or even the US Embassy, back in the 60s, that would have meant that your wages were going to be subject to tax by the Australian Tax Office, the ATO. So when JDFPG was created, the US government didn't want the salaries of private defense contracting companies to be exposed to Australian tax. And so that's the reason that they negotiated this informal agreement. Australia felt uncomfortable giving up its inherent right under international law to tax wages earned on their soil. And so part of the agreement included Article 9 that said Australia will agree to give up its inherent right to tax wages earned in our borders if those wages are brought to tax in the United States. And the understanding at that time was that meant that you had to give up your right to claim the foreign earned income exclusion. So that way there's not a situation of double non-taxation. And so the US government agreed to it, and that was pretty much it. They realized that because it was not an actual treaty, the only way to effectuate it was on an individual contractual basis. And so that meant that you had to be presented with a closing agreement, which is effectively a contract. It's a trilateral contract between you, the ATO, and the IRS, and you would agree to give up your right to claim the foreign earned income exclusion, and Australia would in turn give up their right to tax your wages earned in their borders. So it seemed really simple and straightforward. Here's the actual problem and where the problem kind of stems from. The deal that America negotiated with Australia was a really bad deal. In the vast majority of other bases throughout the world, the US actually negotiated a total and complete exemption with no strings attached whatsoever. I really don't understand why the Johnson administration agreed to this. I mean, because to be honest, there was really nothing out here in Alice Springs before JDFPG. So I mean, the economic incentive of a US military base being out here was more than enough to negotiate a no strings attached total exemption. But, and not only that, but one of the main reasons why private defense contractors take overseas assignments is for the tax benefits. With Internal Revenue Code sections 911 foreign earned income exclusion, currently it's indexed for inflation. This year, I believe it's $105,900 of your salary that you get to exempt from tax. On top of that, you're also not taxed on your housing benefit. When you put those two together, the total tax-free nature is around $150,000. That's the equivalent of earning $200,000 stateside and then having to pay 30% federal and state tax. So obviously there's a huge financial incentive there. The Johnson administration should have known that the foreign earned income exclusion was critical to the talent retention strategy for the private defense contracting companies out here, but Johnson administration wasn't really known for its business acumen. So given the fact that America negotiated this really bad deal, JDFPG started having difficulty attracting talent out here with the JDFPG team. Yes, it's still good for your career to accept a short-term assignment out here, but again, the real benefit to living in a remote area outside of the United States, outside your comfort zone, is really going to be the tax benefits. So even after they changed their hiring strategy, they started focusing a lot more on data-driven, psychology-based hiring to make sure they were hiring people that could actually live comfortably in a remote area. There was still a shortage of talent. And so, especially for those that were making far beyond the exclusion amount and really needed the foreign earned income exclusion to justify taking the position, some people ended up finding out that they effectively took a pay cut when you look at it from the after-tax perspective, when they got surprised with the tax situation. So what did the folks running JDFPG do? Did they try to negotiate a better deal with the Australian government? Did they try to work out some sort of a new deal? No. Instead, they just decided, well, let's just not tell anybody until they actually get here. And that way it doesn't jeopardize the onboarding acquisition process of talent. And so they would wait till you sort of pass the point of no return to then sneak it on you and say, oh, by the way, forgot to mention this, there's this closing agreement that you need to sign. So, that in the legal world has a very specific term. And actually there's multiple terms for it. One is fraudulent inducement, another one is fraudulent misrepresentation, and those can also result in situations that create coercion and duress. And so that automatically, by operation of law, invalidates any contract, whether that contract is with a used car salesman or with the governments of Australia and the United States. A government has no more of a right to fraudulently induce or misrepresent or create situations of coercion and duress than a used car salesman does. So, but unfortunately, that's the path that they chose to, resolve the situation of being unable to attract quality talent, again, out here to the team at JDFPG. So that was really their first mistake. In the late 1970s and early 1980s, a new trend started emerging in the world of international law and international tax. Bilateral income tax treaties between nations started becoming the new norm. And so it was a lot better than the situation before, where Australia would impose their tax rules on an American, and then America would say, well, you are taxed on your worldwide income, so we're going to tax you as well. And so you end up in these weird situations or not weird, but nightmare situations of double taxation, where you have two countries both asserting taxing rights, and your effective income tax rate jumps up to 70 or even 80%. So today, tax treaties assign taxing rights based on, it's a little bit of an overgeneralization, but generally based on three factors. It's either going to be the source of the income, so where was the payment made from, or the country of residence, so the individual taxpayer, where were they resident when they actually received this income, and then taxing rights are assigned to that jurisdiction. Or when it involves governments and governmental functions, it's going to usually be the government that benefits from this particular activity gets taxing rights. So these treaties are negotiated and drafted for the most part, actually almost entirely, by the Congressional Joint Committee on Taxation. And this is a committee consisting of both U.S. representatives as well as United States senators. And it's from the House Ways and Means Committee and the U.S. Senate Finance Committee Subcommittee on Taxation. And they get together, they're the ones that actually negotiate, draft the treaties, and then once it's done, they present it to the President of the United States for his signature. And after the President signs it, it has to go back to the United States Senate on the floor for a full vote. And then once a majority of the U.S. Senate ratifies the treaty, then and only then it has the full force and effect of law under U.S. law. So that's the process by which an international document becomes and has the full force and effect of law under U.S. law. So in 1984, the United States and Australia signed such a treaty. It's formally titled the Convention for the Avoidance of Double Tax, the Convention between the governments of the United States of America and the Commonwealth of Australia for the avoidance of double taxation and fiscal evasion. But informally, everybody in the industry, we just call it the U.S.-Australia Income Tax Treaty. Nobody ever calls it that long name. If you hear anybody use that, they're really inexperienced. And it assigns taxing rights for a variety of articles of income. So for example, some of the things that are pretty standard is dividends and interests are generally taxed in the country of residence. Social Security is generally only taxable in the country of source. Some treaties, because of unique circumstances, change it to country of residence. And then private pension distributions are generally only taxable in the country where the recipient actually received the pension distribution. So for example, if an Australian works in the US, earns a 401k, moves back to Australia, and then extracts the funds, even though it's a US-based 401k, the US loses taxing rights because the individual has reestablished tax residency in Australia. So it can create weird scenarios like that banks have never seen, but that's where we come in and we represent our clients and we let them know, like, yeah, under Article 18, Paragraph 1 of the US-Australia Income Tax Treaty, it's actually only taxable in Australia. So that's generally how it works. Now, on the topic of wages, there is a split. So there's wages of private companies, and then there's wages attributable to governmental functions. So general wages are taxed under Article 15, and that generally says, standard international law rule, it's wherever you physically perform the service. So that means if you spend 183 days in Australia and then 183 days in the US, then that's going to be effectively 50-50 that's split between the countries. But under Article 19, there's a different treatment. So so let me just get back on track. So in some of the treaties, the Article 19 requires the individual to actually be directly employed and paid by the government. And in other treaties, this is extended to private companies that are performing government-like functions, such as military research and development, surveillance, and digital intel acquisition. Article 19 of the US-Australia Income Tax Treaty is titled Governmental Remuneration. Now, this is where semantics comes into play. And this is where legal reading comes into play. The reason that this is important, and it's not just semantics, is because the term governmental is an adjective. It's descriptive. Other treaties use the very pointed phrase government remuneration. That's a very straightforward. That's a noun. And in other cases, it's clear that they're referring to people directly employed and being paid by the government. However, when an adjective is used, it means government-like services performed by a private company. And this is supported by the fact that the technical explanations to the US-Australia Income Tax Treaty specifically state that it extends to individuals performing, and the quote is, government-like functions. Now, again, this is still implied and not directly stated, but it's obvious to any legal reader that Article 19 extends to employees of private defense contracting companies. Because again, there's no need to hyphenate it with government-like services if the person's working for the government. If they're working for the government, it's government service. One of the reasons why the US negotiates this, and now it's kind of becoming the norm in the income tax treaties, is because in most countries, it's the government itself that does military research and development and surveillance and all these other functions. But the US is different. We have what Eisenhower called the military industrial complex, which we have the contract bidding system, and a lot of these functions are assigned to private enterprise. So that's the reason why Article 19, the US Senate Finance Committee Subcommittee on Taxation started focusing on extending that to private companies because of that unique nature. So it was this treaty that changed everything in 1984. As of 1984, you were not supposed to be signing closing agreements, contracts, waiving your right to claim the foreign earned income exclusion. Despite the fact that many of the employment contracts that we've read with all the companies have specifically had clauses in there that state the company will not provide any legal or tax advice, their actions were the exact opposite. They directly told you, you have to sign this or you risk losing your position. Some people even communicated to us that they were told that they had to sign it because there was a defense treaty that required it. And again, that is called material misrepresentation of the law, and that automatically invalidates a contract as well. So, and as I explained earlier, it's not a treaty. It was only signed by the Secretary of State and the Secretary of Defense. It was never presented to Johnson for a signature. It was never presented to any president for a signature, and it certainly was never ratified by the US Senate. So that document has absolutely no force and effect in the United States. It's just an informal agreement. That's why they have to back it up with a closing agreement. Because if not, then it's not worth the paper it's printed on. They doubled down on the coercion and misrepresentation and effectively provided incorrect legal advice. And this was their second mistake. This continued for 33 years until Scott Meredith contacted our firm in 2016. So Scott was convinced that something wasn't right. And after we completed our very thorough and meticulous legal research, we concluded that he was actually correct. We were so convinced that we were correct that we told Scott, well, you know what, we got to prepare amended income tax returns, submit this to the Internal Revenue Service, claim the foreign earned income exclusion, and that way we can go ahead and get the excess tax that you paid back over to you. But we also let him know that we could actually only go back 3 years. And so we had to explain to him the statute of limitations. Under section 6501 and 6511 of the Internal Revenue Code, there's a 3-year statute of limitations. The IRS has 3 years to audit your return, or they have to basically, forever hold your peace. You can't audit after that period, unless you can show fraud or something like that. But that's a really high standard, and courts very closely scrutinize that. So outside that 3 years, his question was like, well, wait a minute, I've been out here since like 92. Who's liable for 1992 all the way to 2000? I think for him it was 2013. Normally, our answer to that would be no one. You're SOL. But in this unique circumstance, there was a situation where you were actually provided incorrect legal advice, and that also has a term in the legal world. It's negligence, and negligence creates liability. That is the single most important thing to take away from this. That is why the companies are fighting so hard to advocate on behalf of Australian taxing rights. It's because they provided incorrect legal advice that exposes them. We calculated the total exposure to be somewhere around $28 million that they would owe. If when we eventually file the class action, and they have to, and they're going to be compelled to actually reach out to everybody that's worked here since 1984, that's the total exposure. It'd be anywhere between 20 to $40 million that they're on the hook for, not the IRS. So, yeah, the first thing, what we now know and what we learned, because we had never run, I'm going to be honest with you, we'd never run into a situation like this before. We do income tax treaty planning, but we'd never run into this unique circumstance where a company actually provided incorrect legal advice, and there was this weird dynamic where it's an overseas base, and they didn't really tell you until you were all the way over here, and everybody didn't seem to understand the income tax treaty and how it operated. So it's an incredibly rare situation. So initially we had filed a class action lawsuit because to me it was pretty straightforward. Everybody I talked to told me my company said I had to sign this, or pretty much I couldn't continue employment. But when we got to court, we were surprised. The attorneys for the companies didn't say we never did that. They just told the court they haven't presented any evidence proving that we ever said that you have to sign this or else you're going to lose your position. And so we tried to corner them and tell them, are you telling this court that you never said that? And they said, no, we're not saying we never said that. We're just saying you haven't proven we said that. So it's this weird sort of like catch-21 situation where we were just, we didn't expect that. I'll be honest, we didn't expect that. And so what we realized also, so the case ended up getting dismissed, the initial class action that we filed. And what we later realized when we talked with several attorneys in the area as well as the judge is we were kind of jumping the gun. We need to prove first that they were even wrong on the tax issue, because the IRS was saying that they were right, the ATO was saying that they were right, and so that needed to be resolved. So what we later learned, like I said, was that we first have to beat the IRS in US federal court on the tax issue. Then what's likely going to happen as a last-ditch effort is the ATO is going to get involved and then try to assert tax on this side, so they can try to relitigate the merits of the treaty-based position. So then we're going to have to litigate and beat the ATO in Australian federal court. Then and only then we can file the class action to recover all the tax for the years outside the 3-year look-back period. So for Scott, we filed amended US federal income tax returns to claim the treaty benefit, and he ended up getting amended refunds of over $60,000 for the 3 years. It averages to about $20,000 to $30,000 each year. And surprisingly, we submitted this. Usually amended returns take about 4 months to get approved. The IRS, after saying that we were wrong, cut a check within 8 weeks. It was really surprising. Within 2 months, he had 3 checks totaling over $60,000. And so then that's when Scott let us know. He said there are a lot of Americans in the same exact situation as I am out in Alice Springs. And he suggested, I think initially jokingly, that we should come out. And I think he wasn't familiar with our firm. We actually enjoy traveling and doing seminars and conferences. So that's when we actually came out here for the first time in August of 2018. And we held the first JDFPG tax planning seminar where we went through all of this. After our conference, this has never happened before. I've told this story to hundreds of tax attorneys and their mouth drops every time. The IRS decided to hold a counter conference to our conference, and they actually sent 3 people out from Washington, DC to hold a counter seminar actually on base at JDFPG. All of us were just astonished by that. Because we'd never heard that before. Like, they usually don't respond, and even if they do respond, it's not that quickly. And so we thought, something was really amiss here. That is really odd behavior by the IRS. And also, several defense contracting companies began bizarrely leaking confidential taxpayer information, which is actually a huge criminal felony offense in the United States. I mean, so much so that very famously, President Trump has refused to release his tax returns, but nobody's been dumb enough to try to leak it at the IRS because they know they'd be facing up to 20 years in prison for doing that. Like, you don't do it. there's one thing that's very sacred in the world of tax law. It's taxpayer information, and the IRS knows that. And it stems back from the Nixon administration weaponizing, the IRS to go after political opponents, and that's the reason why the laws were written so tightly on that, to protect tax information. So as a result of this intentional leaking, the inspectors general for several agencies had to actually intervene. And this was back in, like I said, around 2017, 2018. Several careers ended, and but it's an entirely separate story. But suffice to say that everybody now understands that you don't play around with confidential taxpayer information, and everybody has the same set of rules to abide by. So after that, I'd say hundreds of people started coming on board. We started filing a lot of amended returns. Everybody was pretty confident in our firm's legal position. And we had reached that point of critical mass where we had concluded, this case is pretty much on course now for, inevitable victory, and still is. Shortly thereafter, the international division at the IRS became pretty enraged, and they sent a letter to their legal department in Philadelphia. And they said, we want you all to research this, and we want you to develop grounds for challenging this firm's legal position, and for justifying that they are not entitled to the foreign earned income exclusion. Well, in, I believe it was it December of 2017 or 2018? Well, no, that would have been shortly. It was December 2017. In December of 2017, we got contacted by IRS attorney Brett Lamore with the legal research department in Philadelphia. And Mr. Lamore told us that he had researched the issue, and I really thought he was just going to say we disagree and we're going to take it to court. He said, we've thoroughly researched the issue, all the attorneys here in the legal research department, and we've actually concluded that you're correct. I actually thought it was a crank call. I had to ask for his, I was like, can I have your employee ID number? And I got it. I actually included it in the blog article that a lot of you have seen, because I was in such a disbelief that the IRS's legal team reviewed this and basically concluded that we were correct. So it was a really exciting time at the firm. We were all really happy, that we were proven right yet again. And I would say it totaled to hundreds of thousands of dollars that started coming back for, pine gappers. Sorry, that's what we call you guys. And so, we were preparing to pretty much call it a day, another issue, resolved by Castro Company, and everything was going to be on course. You guys wouldn't need us anymore. You could file your own taxes, claim the foreign income exclusion, and that would be the end of it. But the IRS International Division decided to strike back. They were, again, absolutely furious with their own legal department's conclusion. And so then they contacted the Office of the Chief Counsel at the IRS. Now, there's two different divisions. There's the ones that do the legal research, and then there's the ones that do the litigating. The Office of the Chief Counsel, they're the litigators. So they contacted the litigators, and they basically said, we don't know what's wrong with the legal research department. They're being too objective, and they're basically agreeing with this firm, and we want this absolutely challenged. So they got the green light from the Office of the Chief Counsel to reopen all of the prior amended refunds that they had approved. So these were cases of people that had already come on board, they got their money back, everything seemed great. They reopened all these cases and began re-examining and assessing tax, or threatening to assess tax against everyone. These, let me get to that real quick. So in many of these cases, the IRS examiners actually contacted us and they told us, I actually agree with your position, but I'm sorry, I have to rule against you. And we were like, what are you talking about? One of them, she's in the Puerto Rico office, her name is April Salinas. She said, my superiors point blank told me I have to rule against you and assess tax. That is a huge violation of the Internal Revenue Manual that says superiors will not interfere with the discretion of individual examiners. So basically the fix was in before the clients even got the examination notice. And it was being orchestrated from those on top in the international division who missed the fact that the 1966 defense agreement was not a treaty. The closing agreement was legally flawed, and the 1984 income tax treaty was actually the controlling law that applied to the situation out here at JDFPG. So with their credibility and their careers on the line, what they decided to do next was a very clever administrative tactic. They started treating each individual JDFPG refund claim that we had submitted as a separate and distinct case. And they started assigning it to examiners all across the US. from California to Seattle, New York, DC, Florida, even Puerto Rico. We were like, our client's not in Puerto Rico. Why would you assign an examiner in Puerto Rico? But what they were effectively trying to do is tap into the full, I guess, intellectual muscle of their entire international division by assigning these cases to every single possible examiner that had any sort of international experience, in hopes that they could find some way to invalidate our refund claims. They focused on a lot of different issues, some innocuous ones. Some of the things they focused on was the fact that I would sign the return before it was mailed off to the Internal Revenue Service. So they were saying that it has to have a signature from the client themselves. So then what we did is we uploaded a copy of the signature page to the document sharing platform that we use with our clients. The client signed it, sent it back, we sent it. But then they said, well, no, what you sent it is a scanned version, and we need a wet ink signature. And we're like, really? And then there was another situation where it was a wet ink. Oh, we had a 2848 power of attorney on file, but then they said that, well, the 2848 power of attorney is invalid because the person can only grant power of attorney to sign if they're mentally incapacitated or something like that. Basically, they were just coming up with, they knew they couldn't win on the substance. And so a technique in law is if you can't win on the substance, you have to find some sort of procedural technicality to win, because other than that, you don't have a leg to stand on. So that got dragged out for almost 9 months, almost a whole year. And so that was the period of time when everybody here wasn't really hearing anything from us, and they were all wondering, what's going on? We haven't heard from the Castrom company. It's sort of, we're just kind of stuck in this limbo state where they kept on just dragging a lot of these examinations on. And the way it works in law is we can't just take a case to court when we're unhappy with the situation. We have to wait until there's an actual final administrative assessment of tax. And even after they assess the tax, we have to wait until we actually receive what's called the statutory notice of deficiency. And so that's why a lot of people here were getting impatient, but we had to just let them know, look, there's these sort of, BS procedural rules that we have to follow. And unfortunately, that's what causes, what they call the wheels of justice to turn very slowly, but they are turning in our favor. So thankfully, it was in early 2019, we finally got our first statutory notice of deficiency against a client. And I think the IRS was kind of testing us to see how it would respond. Within 48 hours, we had it filed in the US Court of Federal Claims. So then I think they realized, like, okay, never mind. Yeah, they are serious about this. So that's really good, because that case has now progressed and it's actually scheduled for a hearing this July, which means we'll finally have a court decision on this issue this coming July. And I'll get to more on that right now. We're also, there's some other technical rules as well to get a case before the US tax court. We've been trying to make sure that we had a case like that. We finally got it last month. And right now, the petition's actually being drafted, and it's going to be filed either later this month or early in February. And so now we're going to have a JDFPG case now pending before the US tax court as well. So the really good thing about that is these are two separate and distinct courts, the US Court of Federal Claims and the US tax court. And obviously, it doubles our chance of victory. All we need is to win in one court, and it creates a solid path to victory in all other cases. We're actually expecting that we're going to win in both. There's also a third avenue that we're very strategically reserving for the future, just in case, and that's the United States District Court for the District of Columbia. So basically, the federal DC court. And that, so normally, if you're going to file a federal lawsuit, you have to do so in your home jurisdiction. So, for example, I live in Dallas. So if I needed to file a federal case against somebody, it would be in the United States District Court for the Northern District of Texas. Being that you're overseas, DC is actually your court. So it's the United States District Court for the District of Columbia, which handles Americans overseas. So just to give you a realistic projection time frame, what we're looking at, we're projecting a victory in the US Court of Federal Claims in 2020, a victory in the US Tax Court in 2021, and simultaneously likely a victory in Australian Federal Court in 2021 as well against the ATO. We're expecting that when the governments lose, they're likely going to file appeals. And so we think those appeals will probably be resolved in 2022. And we're expecting a final resolution to all the legal matters in 2023, which then allows us to file the class action, sometime mid to late 2023. The reason I wanted to be very clear about that time frame is because I think last time I painted too rosy of a picture of how fast things would move along. and I didn't expect so much pushback, very unreasonable legal positions and pushback from various people involved. And so now I just want to make sure that I'm a lot more clear about the time frame that we're actually looking at. So as is standard in the case involving the U.S. Court of Federal Claims in DC, DOJ Tax Division was assigned to the cases, and even they're having a very hard time defending the IRS's position, especially because they even haven't rebutted our position on the 1966 defense agreement. But they are digging in their heels on the closing agreement, and they're claiming that it's 100% valid and enforceable, even though they've already admitted they have no direct knowledge of how the signatures were acquired or any statements that were made during the acquisition of the signatures. And so a lot of people have asked about that. Why would DOJ be putting up such a fight? Long story short, it's their job. It's not DOJ's job to question. Well, I mean, technically they can question the validity of a claim, and if they feel that that a particular position is incorrect, they can take a contrary position, but usually you're sort of painting the target on your back. I'm pretty sure you remember when Trump got in office and DOJ refused to enforce a few things, he immediately just terminated them. So, but nevertheless, it's in court, and it's just a matter of time before they lose, because all these cases are pretty much on autopilot. So we think that winning in U.S. Court of Federal Claims in DC is a foregone conclusion. Now, what's likely going to happen after that is JDFPG is going to come back and they're going to say, well, it doesn't really matter because this isn't really a matter involving U.S. tax. It's a matter involving Australian tax. If you don't sign the closing agreement, then Australia has the right to ignore Article 9 of the 1966 Defense Agreement and impose tax on you. So this actually is an Australian tax matter. So just letting you know up front, that's going to be their next argument. So they're basically going to ignore the court decision in the United States. So, and proof of that is the fact that now we have John Winter at the ATO, who's been contacting several of our clients, threatening to assess tax if they don't reverse the claim of the foreign earned income exclusion that they took. And so what we've explained is, number one, we're ready to immediately sue the ATO in Australian federal court if they attempt to assess tax on any of you. We have two firms lined up, and pretty much they're ready to go. They've been ready to go for like 18 months, but the ATO has just been consistently barking without actually backing it up. And what we've explained to everybody is the ATO is bound by the 1984 Income Tax Treaty. So, the whole thing that I mentioned about Article 19, and this is governmental remuneration. And under the terms of the treaty, they don't have any right to tax the income. Just like in the United States, we have no right, the IRS has no right to tax the income earned by diplomats in downtown DC. They're working at the embassies, it's governmental functions, and so we can't tax them. And so if they rule against that in any way, they risk the US Treasury and the IRS similarly retaliating and imposing tax on their diplomats in DC, which Castro & Company is actually a registered lobbying firm in DC. I will personally lobby very hard for that as a countermeasure to them imposing tax on our Americans over here. So we've also reminded the ATO that it was our firm 7 years ago that defended Australian